For decades, venture capital focused almost exclusively on financial returns. Investors chased growth metrics, market potential, and disruptive innovation, often sidelining concerns like sustainability, ethical governance, and social responsibility. The assumption was simple. Early stage investing was about scaling fast and capturing market share. Everything else was secondary. But the world has changed. ESG, environmental, social, and governance factors, has moved from the periphery to the center of investment strategy. It is no longer just a corporate responsibility initiative, it is now a core driver of long-term value creation. Companies that embrace ESG principles are proving to be more resilient, more attractive to talent, and ultimately more profitable. In today's venture landscape, ESG is not about compliance, it is about investing in businesses built for the future. Why does ESG matter in venture capital? The answer lies in the forces reshaping the global economy. Regulatory pressure is mounting as governments demand transparency in ESG reporting. Consumers and employees increasingly favor companies that operate ethically and sustainably, directly influencing which businesses succeed. Limited partners who provide the capital that fuels venture funds are prioritizing ESG-aligned investments, requiring VCs to integrate sustainability and governance into their decision-making. ESG is not just a moral imperative, it is a risk management strategy. Startups that ignore it face potential regulatory fines, reputational damage, and consumer backlash as they scale. Climate risks, data privacy concerns, and social impact failures can become existential threats. Forward-thinking investors understand that integrating ESG early reduces long-term liabilities and enhances value creation. Beyond mitigating risk, ESG is a powerful indicator of a company's strength. Businesses that weave ESG considerations into their core operations tend to have more resilient leadership, lower operational risks, and stronger financial performance. They attract top-tier talent as employees increasingly choose to work for companies that align with their values. Investors who overlook ESG may be taking on hidden risks that could undermine future success. Yet, many venture firms still treat ESG as a box to check rather than a strategic advantage. To remain competitive, investors must go beyond compliance and embed ESG into their core investment approach. This starts with integrating ESG into due diligence. Traditional assessments focus on market potential, business models, and financial projections. But a more comprehensive approach evaluates environmental impact, ethical governance, and social responsibility alongside financial health. Key questions emerge. How does a company minimize waste and emissions? Is it fostering diversity and fair labor practices? Are its leadership and decision-making processes transparent and responsible? The misconception that ESG slows growth or adds costs is fading. In reality, companies that embrace ESG early are more competitive. They attract loyal customers, build strong employer brands, and secure larger funding rounds from institutional investors. Rather than being a constraint, ESG can be a catalyst for growth, differentiating startups in a crowded market and making them more attractive for acquisitions or IPOs. But integrating ESG into venture capital doesn't stop at the investment stage. Firms must actively engage with their portfolio companies to ensure they implement and maintain ESG commitments. Providing ESG playbooks, tracking key impact metrics, such as carbon reduction and diversity benchmarks, and tying ESG performance to future funding rounds ensures that startups scale responsibly. The best VCs do not just write checks, they guide their investments towards sustainable and ethical growth. For those still skeptical about the financial case for ESG, the numbers speak for themselves. ESG-driven startups tend to outperform in the long run. Brands that lead with sustainability, like Patagonia and Beyond Meat, have captured dominant market positions. Diverse and ethically governed teams make better strategic decisions, leading to more innovation and stability. Meanwhile, venture funds that align with ESG principles are attracting increasing interest from institutional investors, pension funds, and sovereign wealth funds. Those that fail to adapt may find themselves losing out on capital, co-investment opportunities, and access to high-growth industries. Looking ahead, ESG will only become more entrenched in venture capital. Climate technology and sustainability startups are receiving record-breaking funding as investors recognize the financial and societal imperatives of tackling climate change. Diversity, equity, and inclusion are shifting from talking points to core investment criteria. LPs and regulators are demanding standardized ESG reporting, making it harder for venture firms to ignore sustainability. And as impact investing continues to rise, the next wave of market leaders will be those that blend financial performance with measurable social and environmental progress. The takeaway is clear: the VCs who lead in ESG will lead in returns. The most successful investors will not merely follow trends, they will shape them. They will embed ESG into their due diligence and decision-making, recognize it as a driver of growth, and hold their portfolio companies accountable for sustainable and ethical leadership. They will invest in future-proof industries that align with global sustainability goals. Because in venture capital, the companies that define the next decade will not just be the most profitable, they will be the most responsible. ESG is no longer optional in venture capital. It's a driver of financial performance, risk management, and market leadership. Firms that integrate ESG into investment decisions, track sustainability metrics, and hold startups accountable will outperform those that treat it as an afterthought. The next wave of market leaders will be those that balance profitability with responsibility, because in the evolving VC landscape, the most valuable companies won't just be the most disruptive, but the most sustainable.